Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen, VP of Online Distribution with BMO ETFs. And today I'm happy to be joined by Larry Berman from ETF Capital Management. Now, I consider Larry a bit of a pioneer in investment management as one of the first to really adopt an ETF-focused approach in his tactical portfolios. So today we'll get into his thoughts on the market, some ETFs that he's using in his portfolios, and much, much more. But before we get started, just a quick reminder that we're not providing you any investment recommendations or advice. This channel is all about providing education around investing in ETFs and the markets for Canadian do-it-yourself investors. So Larry, welcome back to the show. It's good to have you on today.
Thanks, Erin. It's always fun to do these conversations about markets with you.
Absolutely. Now, Larry, for our viewers, has over 36, correct me if I'm wrong on that, Larry, years experience in the industry. He also appears weekly on his show on BNN, Berman's Call, where Canadians really look to him for information on the markets, which he provides in a way that's really digestible, which I think is why your show is one of the top ranked on BNN. Larry also has a YouTube channel, so check that out, where he does his weekly updates and takes questions from investors there as well. So Larry, your tactical approach to investment management is definitely unique in the marketplace. I think it always leads to an engaging discussion around the markets. So I don't want to waste any more time. Let's get right into it. Let's turn to the markets we're experiencing today. As always, there's no shortage of topics that I think we'll get into today, but high level, Larry, to kick things off, maybe you can talk to us about some of the current risks in the market and the current backdrop for investors.
Yeah, so good place to start. Being tactical and active means we can go anywhere and do anything in terms of getting positions in the different portfolios. So with the three different mandates we have, we focus globally on all of them. But when it comes to sectors, a sector's a sector or sector. And so technology is right now, very topical, because you've got this market in 2023 that has been led by a handful of stocks. Everybody is probably familiar with the story by now, that if you excluded like the top 10 performance stocks in the S&P 500 this year, everything else would be down. Globally, internationally, markets are doing relatively well. Canada, energy hasn't been the place to be this year, so Canada's lagging. Banks had their issues. Canada's lagging. We got a lot of banks and energy. So, it's not so much about the country sometimes or the sectors, but this is a year where both of those things are really important. So with that flexibility to go anywhere and do anything, last fall when we felt technology was cheap, we added exposure to the portfolios tactically. We did that in the dividend fund with the newer BMO ETF ZWT, which is, the big tech names with covered call overlays. So we get that enhanced yield. A lot of those technology stocks don't pay big dividends. So it's a very, very nice way to get that yield into the portfolio and the exposure for clients. And we increased exposure with a ZQQ, for example, in our more growth-oriented or balanced portfolios to get that tech on. Well, after the rally in January, I was kind of shocked to see how the market started the year, and we took that off. And so that looked really good up until they threw a lot more money at the world after the banking crisis in March, and techs kind of led again. But you have Microsoft trading at 35 times earnings, and historically, fair value for a growth company like that, 25x. So it's really expensive, and Apple at 30x probably deserves, a mid-20s or low 20s multiple and so forth. And so markets are expensive. Those two names, Aaron, in the S&P 500 together are almost 14% now, and the top five are more than 25%. And that's the biggest it's ever been for the top five names. So you have this very, very concentrated world. And if you're not in that market cap weighted ETF and you don't have 6-7% exposure to Microsoft and Apple in your stock portfolios, you're lagging significantly this year.
Yeah, for sure. And then let's look at interest rates a little bit, because we had rate hike in Canada last year. This week, hawkish pause by the Fed. So what are your thoughts around this environment, and what can we expect? Get a crystal ball.
Yeah, so looking at the way the bond market responded to the headlines and to the press conference and even into the day after the FOMC, you're getting a lot of mixed messages. The narrative, depending on who you're listening to on Wall Street or Bay Street, can be very, very different. I think, Aaron, that speaks to the uncertainty around the outcome. Powell at one point, thought they had very hawkish, but in the press conference didn't sound very hawkish, and so the market took that as a positive, meaning, yeah, the Fed's put that out there, but they're not really going to do it, and then you get some economic numbers that come out, retail sales a bit better than expected, but still softish on trend, and then you get initial jobless claims. Last week when the big jump came up, they said, oh no, where it was related to the holiday around Memorial Day in the US, don't worry. Well, now you got a second week in a row of 260,000+ job losses in the US. And so, it's interesting because, okay, now if we're going to get that job loss and harder economic landing, why are they buying stocks? Well, the hope is that they're going to cut rates. Well, the Fed told us they're not going to cut rates this year. So you've got a lot of divergences and uncertainty, but you also then have a whole new universe of investors that have learned how option markets work, and you got these squeezes developing in some of these overvalued areas that maybe big hedge funds are starting to short now, but because of the way option hedging works, you can take a little bit of money, control a lot more, and put some leverage into the markets. And so a lot of that is driving right now. The uncertainty around the outcome is supporting that at the moment. It's not going to last forever, but I can't tell you how long it's going to last. If I was running the Fed, there's a difference between what I would do and what I think is going to happen. I think they've done enough. I think we're going to start to see the economic slowing, but I also think core inflation is going to be persistent, as they believe it is. And it's going to be very, very difficult without a hard landing to get that core inflation to come down towards their 2.5% comfort zone. Their own summary of economic projections has that core PCE measure at 3.9 by the end of the year. It's currently above 4.5. So that's some progress. But as Powell said in the presser, it's not enough. There's more to do. And next year, they're forecasting, going to 5.6 as the median rate, back to 4.6 by the end of next year. So 2 more hikes followed by a couple of eases. And Powell said easing could be, a couple of years away. So I think the rate cut scenario is pushed well into next year at the best. And those are the dynamics. And of course, they're data dependent. So if the economy falls off a cliff, there's no clear evidence that's happening right now. Definitely the low-end consumer is stressed. And all that, has implications for interest rate markets, how they're funding and replenishing after the debt ceiling got raised, how they're doing that in a way as to not put pressure on the bond market. Yet you have this QT that no reporter actually asked about yesterday. What's about the balance sheet? How are you going to unwind that? the Fed still needs to not only fund, or the Treasury needs to not only fund a couple $1 trillion between now and the next election in terms of spending needs, but they're going to have another $2 trillion run off of the Fed balance sheet. To me, that's going to put upward pressure on interest rates in terms of how they fund it, in terms of coupon supply. That's not in the current market environment when you look at equities just screaming higher.
Yeah, definitely not an easy thing to predict, and lots of variables that are gonna play into it. But it does seem like that higher for longer narrative is definitely rooting in, generally at least. Let's look at currencies, because taking currency exposure, deciding to hedge currency in a portfolio, whichever way you choose to do it, it's definitely a personal choice. But ETFs have made it so easy to take a tactical approach to hedging, which as you do in your portfolios, Larry. So how are you positioning when it comes to currency, and what are your thoughts on the CAD USD right now?
Yeah, so the general thought in our mind is to be fully hedged on the currency as a default. I want the pure exposure to that market. Now there's a cost to hedging, but typically when you're hedging something like Europe, where the funding costs are lower there, the hedge actually pays you. And it goes both ways, Canada, US. So the cost of hedging right now is actually either a benefit or not a big problem. So I'm not too worried about that. And our default, again, when I make an investment in Europe, it's about the market exposure, not the currency. There's nothing worse than, market's up 10, but your currency went against you 10, and you get 0 for making that bet. And I think when you're a global fund like ours are, you have to think about the currency as a big piece. So having said that, how are we positioned today? And so as of right now, about 75% of our exposure to the US dollar is hedged. We recently unhedged a little bit of it as the Canadian dollar has gotten a bit stronger. We're fully hedged on our exposure to international markets in Europe. Emerging market currencies, they're very expensive to hedge, and then by definition, we typically don't do that. So where we have more emerging market exposure, for example, in the portfolios, we're not going to have currency hedges on there, but we have big, pretty significant hedge on the US at this moment. If we get to 140 on the Canadian dollar, let's be fully hedged. If we get back to 125, let's be maybe 50-50 at that point. And so we look at the currency, Aaron, as a separate asset class. And so we make our trades there and exposures independent of our security selection.
Perfect. I want to turn to gold, because it's often looked at as in times of volatility, of course, as a safe haven. So I'd love to get your thoughts on gold.
I like gold.
The opportunity, yeah.
So, gold equities and gold equities are about as cheap as they've ever been relative to the price of gold. So I like them, but you need the environment for them to work. So we spent a lot of 2022 on rallies, reducing our exposure to gold, because the feeling was they were tightening. That's bad for real rates. If you have positive real rates, that's bad for gold. And so gold corrected significantly. We started nibbling and adding as gold equities were very weak last year. And recently gold had another pop to above 2,000. Gold stocks rallied, but didn't really come anywhere close to where they should have been, given gold at 2,000. That's the general perception, that gold isn't going to stay there for a long time. Now that gold is coming off a little bit, I mean, we're only at 1950 right now. So on a comparative basis, but gold stocks from where they were are down about 15%. So, gold has this kind of volatility, and gold stocks have this kind of volatility, and we'll tend to use both in portfolios. And right now, we've got about a third exposure towards our maximum that we would have, in our portfolios at this point. Okay. But looking to add on dips, because when the Fed actually does start cutting interest rates, and needs to do that because the economy's hitting a hard landing and we go back to negative real interest rates, then gold will spike again, and gold stocks should perform, pretty well in that environment. But for now, we're cautious there.
Okay. Energy. So when it comes to oil, we heard, I think it was 2 weeks ago, the cut in production by the Saudis was sort of the big news there. So what are they signaling by doing this, and what does it mean for investors here in Canada and Canadian oil as a whole?
So, I look at the ETF for the sector. BMO has the ZEO equal weight. If you look at the US benchmark XLE, a large cap energy, at 90.95, I thought the risk return wasn't very good. At 70 to 75, it's excellent. 75 to 80, it's good. We're currently sitting just above 80 as in terms of relative ranges. So, what we have done in some of the portfolios is we've added exposure, we've trimmed exposure based on those ranges over the last year or so. And where I've gone to typically is getting out of the old energy names and into the new energy names, the clean energy names. So that trade we like. We do it quite often when the opportunities develop. Right now, recently, we've added exposure to traditional energy because hard landing coming, oil prices coming off. There's a narrative in the marketplace that many are pushing that due to the greening of the world, oil companies, as you've heard this from them, they're not reinvesting in the old carbon oil, right? They know where the future is. So we could very well in the next 5 or 10 years of transitioning away from burning carbon to cleaner sources, an underinvestment in resources. I think Saudi Arabia has enough oil that the world is good. Canada has enough oil, Brazil, that the world is good. In all scenarios, we can turn up the spigots, although in Canada, it's hard for us to sell it to anybody outside of the Americans. And even then, they're not making it easy on us with more pipeline capacity. But I won't get into that political debate for now. But so I like it and I don't, depending on where it is. In the dividend fund, BMO just launched recently ZWEN. So ZW is the put right combination, covered call combination that BMO uses, and then EN for energy. We just added that exposure as oil dipped, below 70, within the last couple of weeks. So we did a rebalance. We're doing the covered call in the dividend fund because we want that enhanced yield, still very much playing defensive. If I wanted the exposure and not to be defensive, I would go into a ZEO and get the pure upside. But if we got a hard landing still, maybe oil prices haven't bottomed out yet, but the yield is pretty compelling there by way of dividend and volatility premiums. Even though volatility's come down considerably, it's still relatively high in the energy sector.
Yeah, we saw a lot of money going into energy last week overall into ETFs. Was it all Larry? I don't know. But
well, I talked about it on BNN.
Okay.
And I think I probably on my YouTube channel as well, because I often comment on some of the trades we're making, and for clients. So, why not use that as a venue to talk about it and kind of disclose our strategies.
Yeah. Very good. And then would love your thoughts on US banks and what's happening there with regional banks. And I've been reading more and more about how Canadian banks, are potentially safer way to access financials right now. So what are your thoughts around that?
Yeah, we are, but Canada's got their own real estate issues in terms of affordability and everything else, and kind of risk around mortgages. So from time to time, you get Canada's a short because real estate's too expensive, and that pressures the banks, and you get some selling. But we have a very, very different system here in Canada than we do in the US. In the US, with all these smaller regionals, like there's thousands of them, you know, savings and loans and smaller banks. The smaller banks are still very, very big institutions. Some of those small banks that went under, you know, had similar market caps to some of the Canadian banks, the smaller Canadian banks, when you think about it. So, you know, you got to have that sort of understanding of it. The mark-to-market losses that they were forced to take because you had a classic run on the banks. People were say, give me my money back, moving it to a money market fund that get me a higher yield versus my deposit account. Aaron, this has been the fastest rate hike cycle ever, right? Most intense. The central bank was most wrong about temporary. They had to step on the gas. And some of these smaller banks maybe don't have the experience as the larger banks do in terms of hedging their hold to maturity portfolios, right? And so I think most people understand what the issues were. This is not about bad lending in small banks, although there's some real estate, specifically commercial office real estate. That part of the cycle is probably for the next two or 3 years in front of us, yet to play out. So there's not a lot of short-term catalyst for upside other than some mean reversion. And maybe they got oversold from that perspective. But I do think if that hard landing comes, then there's some more pressure coming to these regionals. And to me, that would be the buying opportunity. So it's on my radar. I haven't put any exposure either in Canada or the US right now, but it's on my radar. The yields are compelling, not for the regionals in the US, but in Canada. And so a little bit more weakness during the harder landing economic downturn, which the markets are not pricing in right now, and I do believe is coming. And you know, banks would get hit a little bit harder, you know, in a harder landing scenario there. So no direct exposure at the moment, but it's on my radar, and we'll fill that trade when we think the timing is a bit better.
Seems to me that social media also played a role in all of these bank runs that were going on. Like that time, just the way everything's evolved in the news cycle, it just had to play a part too.
So a lot of these private equity shops that use Silicon Valley Bank as their banker, you know, the C-suite, not only did they have their own money in the bank, but they had the corporate money in the bank. And there was a comment put out, some very high profile private equity people, and said, hey, you know, maybe you should think about diversifying that risk a little bit. And you know, that's kind of what caused the run, and a run begets a run, right? Your neighbor's doing it, well, if I don't do it, I'm going to look stupid. And so, you know, that really exacerbated, I think, the moves there. And so, you know, 2 banks went insolvent, one got taken over. The programs they put in place to guarantee some of those deposits, obviously working now. There's still some residue there to get through. If we do get that hard economic landing, there's some more pain there that will come. But in theory, the bonds that are causing the stress would rally in that environment, government bonds, and so that would help mitigate some of the mark-to-market losses. So there's a little bit of an offset there, but at the time, you know, it was really unfortunate for these banks.
And then you touched on tech a little bit, but I'm going to throw it, want you to expand on that a little bit. Obviously seen a run earlier this year, but do you think there's still legs to go in that, or you mentioned you've kind of paused?
Yeah, so I think we have the setup here where a lot of speculators are squeezing investors. There's no way to forecast and predict when that ends. It ends when it ends. We can monitor for change. So delta helps us see the change, the speed of the advance. So is option gamma, the option gamma effect, in other words, the leverage that you get from using options, and how the market makers have to hedge by buying even more securities the more the market goes up, regardless of value, because they have that risk to hedge. That's what's going on right now. I don't think a lot of people fundamentally are buying Microsoft at 35 times earnings. I can't tell you a fund manager that in their right mind that would have that view at the moment. I'm sure there are some that are more growth oriented and the multiple doesn't matter as much, but and then you have AI, right? So you have this new thing. It's not .com-ish, but that the AI story and monetizing it, measured in decades. And so the markets like to price in things really fast, and then bubbles pop, and it takes 20 years to grow back into those multiples. NVIDIA, great company, but do you not think you're going to get caught up by some of these others? I don't know. So do you want to pay 100 times for NVIDIA? Are they going to grow into those earnings or grow into that multiple? Or is AMD going to start eating their lunch? Is Intel turning the corner? Intel, would I rather buy Intel at 12, 13 times earnings, or with prospects and value, or NVIDIA at 100? Right? Like that's what's going on right now, and having a growth at a reasonable price and a value tilt. I can't buy NVIDIA and not Intel. Like that just doesn't fit my lens. I might be wrong on that still for 6 more months, right? Like you look stupid when markets are doing something and you're not participating, but you got to hold to your core values and your style, because if you start chasing, that's that's seat of the pants investing. It's not methodological, and you don't want that in a portfolio manager.
And for us, you manage just one ETF, but 3 funds. The ETF is ZZZD, the BMO Tactical Dividend ETF, also known as the Sleep at Night portfolio, hence the ticker. It's performed really well recently, year to date especially. So walk us through a bit more in terms of what's been working there.
Well, overweight to international has been a big part of that, where yes, the S&P 500 has done well this year, but it's been very narrowly concentrated. We felt there was a lot better value in Europe, and they worked their way really well through the crisis of the Russia-Ukraine, like the awful humanitarian situation that's going on there. I'm beside myself when I see headlines coming out of that part of the world. But Europe managed to get through that really well. So you had a lot of investors sell Europe like crazy last year, made it even more valuable relative to the overvalued US market. So as someone with a value tilt, I recognize that you actually get a better dividend yield into your portfolio internationally than you do in the US. The S&P 500 yields about 1.5%. And so even with a covered call overlay, it's hard to extract. Europe, we were getting 6, 7, 8% with a covered call strategy in European exposure, and even in the underlying, you were getting 4.5 or 5. So you just don't get that anywhere else. So the only place then that you get the benefit of a dividend tax credit is from a Canadian corporation, which Canadian banks, energy companies, and insurance companies. That's what you get when you buy the Canadian dividend basket mostly. We don't have a lot of consumer stocks. We don't have a lot of technology, and where we do, no dividends. And so if you're a dividend yield focused strategy, Canada's not a great place to be, but BMO's got this ZWU ETF, which is, utilities covered call, and we have a nice allocation to that. and now the global ZWEN for energy, and there's some Canadian names in there that are helpful for the portfolio. So, we'll get that yield. Right now, the yield, Aaron, is north of 6% in the portfolio. And the risk level is as low as we've ever had it. So the sleep at night factor is up here. The yield is up here. And the risk factor is way, really low. And so if the market's correct, it's a nice place to clip a coupon. It's not a bond alternative. It is equity exposure. Don't make a mistake about that. But I like the positioning right now. We've got about a 30% exposure to emerging market dividends. We recently raised our exposure to emerging market small caps, an area where I think over the next 5 or 10 years, there's tremendous value and growth potential. And you can extract a pretty decent yield in small caps, which is rare, but emerging market small caps can offer that.
Very good. Yeah, I think over 1 year, you're almost up 7%. So it's been doing really well for investors. It's good to see. Now, to finish off, what's your outlook for the rest of the year? What can we expect? Just a minor question.
Yeah, just a minor question. So I gotta say, if I knew with certainty, I'd have all the money in the world, and you would never hear from me again. But on a probability basis, which is how we think, harder landing over softer landing, and hence why we're at maximum defense in the 3 portfolios right now, by way of mitigating that downside if we should get it. So if you look at soft landing outcome that the market is priced for, what happens if that actually plays out? The Fed is able to raise interest rates as much as they have, faster than any time in history, and us to not have a recession and inflation to come back down to their target. I mean, please, that the probability of that happening is not zero, but it's so low. You look at the way option markets are priced right now. So I take the NASDAQ and I look 10% higher out of the money, 10% lower by October. I like to look at October because it's the seasonal weak spot. Theoretically, right, Aaron, how would you think that risk is priced by option market makers? 10% down versus 10% up. Where's the higher volatility risk? Right, you would think to the downside, right?
To the downside, yeah.
If you look at that 10% out of the money call spread and that 10% out of the money put spread, the call spread is more expensive than the put spread. That tells you about the skew right now and the bias into what's happening with this leverage coming into markets. Is that the reality? I don't think so, right? So there's a mispricing there, but you never want to short a market like this either, because you don't know, when it's going to end. So all that said, we're very, very cautious. If you look at earnings and say soft landing, 220 is this year's number, 2023. Next year, 245 for the S&P 500. So that's 9.5% earnings growth. An awful lot has to go right for that earnings number to happen. If we think the soft landing, so the economy goes at 0 to 1% growth, that's the Fed forecast, 1.1 for next year. So anemic economic growth, inflation running 3. So you have a nominal economy, right? Real growth plus inflation at 4, 5. So that's called your revenue growth, right? So revenues for companies can still grow. In that environment, they can still generate positive EPS. But 9%, you got to be kidding yourself. Now, let's look at the hard landing that isn't priced into the market right now. And in the hard landing scenario, 220 this year, maybe we get there, maybe it's 215, whatever. But 2024 in a hard landing is not 245 it's 10 or 15% lower than we are now if it's a normal course correction to earnings. So if the nominal economy, so we get a hard landing, inflation's not 4, it comes back to 2, and it's not zero growth, it's -2. So now you have no revenue growth and probably slightly negative in a lot of key sectors. And the multiple in that environment isn't 20x, it's 16 or 18. 18 would be still premium priced. 16, a $200 earnings is 3,200 on the S&P. $200 earnings at 18 times, again, which isn't cheap, 3,600. Maybe let's call that fair value if long rates stay down. But what if all that treasury supply and everything else that they have to fund keeps longer rates up? Well, now when you calculate your risk premiums with a higher long-term yield, you get a lower multiple, and therefore, that would open up the 32 to 3,600 window for a downside next year test. Right now we're positioned and protected for that. Which one's going to happen, Aaron? I'll ask you the question.
I have no idea.
Right.
I'm not taking a guess at that.
But our framework is probability. And so
Yeah.
probability right now is certainly 10% lower before 10% higher. And so we think the market is pretty grossly mispriced at this point. But I wouldn't put zero odds on it going 10% higher first. That would take us back to all-time highs. This cycle doesn't command that at all. So it tells you we're speculative. This is not the beginning of a new bull market. The narrative that we're 20% off the low in a new bull market, to me, is journalistic bunk, and it's Wall Street pom-pom kind of thing. I get why Wall Street likes to tell a story.
Right.
The story on AI and technology and productivity, it's very, very compelling. I love it. The only question is, what do you pay for it? And right now we're probably factoring in 5 years of really, really good, earnings growth there that, maybe we don't get, right? Certainly in the next couple of years. So that's where I'm at.
All right. Well, thank you, Larry. Very insightful discussion. I always enjoy hearing your views on the market, and I hope you'll come back next quarter and talk to us again.
Yeah, absolutely, Aaron. Thanks a lot.
Next week on ETF Market Insights, we'll be discussing fixed income. And in particular, we're going to look at key indicators to look at when you're positioning that portion of your portfolio. So I'll be joined by Matt Montemurro, who's our head of the fixed income desk here, portfolio manager for BMO ETFs. And we're going to get his thoughts on the current market and ideas relating to inflation in particular and how you can protect against this key risk in your fixed income portfolio. So very important. Hopefully you'll join us then, and bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.